If I offered you a coin flip, lose $100 on tails, win $100 on heads, most people say, nope, same odds, same dollars. But the loss feels bigger than the gain. Today we'll show how that feeling quietly wrecks money choices. And how to beat it. Hey, it's sketch figures, finance, sketch simply. We're diving into loss aversion, why losing cash hurts about twice as much as winning the same amount feels good. We'll hit the $100 coin flip, how this warps investing and everyday choices, a quick Jesse Livermore detour, and 5 fixes you can use today. If that sounds useful, tap like and subscribe, or stick around for a bonus insight at the end. It's bite-sized and practical. Picture the bet, 50-50 chance. Lose $100 or win $100. Most people pass. That gut reaction has a name, loss aversion. In plain English, losses loom larger than gains. In classic experiments, the pain-to-pleasure ratio clocks in around 2 to 1. Many folks won't take a 50-50 unless the upside is about $200 to offset a $100 downside. That's not a moral failing, it's a human feature. Psychologists Daniel Kahneman and Amos Tversky built prospect theory to explain this. We judge outcomes relative to a reference point, like your current balance, and the value curve is steeper for losses than for gains. Translation: the downslope is slippery, the upslope is gentle. That's why a $100 loss can feel like a gut punch, but a $100 win is just a polite golf clap. Ask a class, would you take lose $100 on tails, win $100 on heads? Hands stay down. Raise the gain to $200. Suddenly, hands go up. That tipping point is loss aversion in the wild. Kahneman uses similar classroom coin flip prompts to illustrate this. Not everyone is equally loss averse, and context matters. Stakes, repetition, and framing can shrink or enlarge the effect. Still, the 2:1 pain ratio is a durable average across many settings. Your brain's default setting is protect current wealth first, even when math says the bet is fair or better. Put that brain wiring into markets. Now we're not talking coins, we're talking your portfolio and your time. In brokerage data, everyday investors show the disposition effect, selling winners too soon and holding losers too long, exactly what loss aversion predicts. It feels good to lock a gain. It hurts to realize a loss, so we wait for losers to come back. Terence O'Dean studied 10,000 brokerage accounts. Investors realized gains far more than losses. This wasn't just rebalancing or taxes, it was the pattern. Overtrading makes it worse. In a big study of 66,000 households, the most active traders underperform the market by 6 to 7 percentage points a year. Translation: trading to soothe feelings can quietly tax your returns. Sunk costs. The same pain shows up outside markets. A sunk cost is money, time already spent that you can't get back. Rationally, you ignore it. Psychologically, we double down so the past won't feel like a loss. In a classic field study, theater subscribers who paid more attended more shows, not because the shows changed, but because skipping felt like wasting that higher price. Sometimes sticking with it is grit, not bias. The key is why you continue, future value or past cost. Loss aversion pushes us to harvest tiny wins and hide from losses, which can be the opposite of building long-term results. If this is clicking, tap like and subscribe. It helps more people dodge these mental potholes. You don't need a brokerage account to feel loss aversion. Your kitchen junk drawer is enough. Endowment Effect, aka because it's mine. People demand more to give up an item than they'd pay to get it, even if they just got it. In mug and pen experiments, sellers wanted roughly twice what buyers would pay. That gap pops up even in markets where people can learn. Why? Giving it up feels like a loss. Faced with options, we stick with the default. In faculty benefits and plan choices, the current option gets picked far more than alternatives, even when a switch would be better. Doing nothing avoids the risk of loss. Changing the default can change lives. In organ donation policies, opt-out, donor by default systems drive much higher participation than opt-in, illustrating how defaults harness our inertia and loss aversion. Defaults aren't destiny. Awareness plus a few friction-reducing steps can flip choices fast. Loss aversion doesn't only move markets, it shapes closets, subscriptions, and even donor cards. Traders have known about "don't let losses run" long before we had jargon for it. Jesse Livermore, often linked to reminiscences of a stock operator, warned against averaging down and preached cutting losses quickly. His own rule-based approach, detailed later in How to Trade in Stocks, emphasized taking small losses before they grew teeth. Livermore also lived the other side. Multiple bankruptcies, including a widely reported failure in 1915 and another in 1934, and massive boom-bust swings. The historical record shows fortunes made and lost, evidence of how discipline lapses, leverage, or changing market rules can overpower even a legendary operator. We can't diagnose which bias caused any specific failure. History is messy. But his life is a vivid reminder. Not cutting losses and doubling down can be catastrophic, while rules that cap the downside are there to protect you from your own wiring. Even pros build guardrails so one bad day doesn't become a bad decade. You can't delete loss aversion. It's baked in, but you can sandbox it. 1. Pre-commit to rules before feelings show up. Write down if-then rules when calm. If a position falls 20% below my thesis, I exit. Or for life stuff, if I haven't used an item in 12 months, I sell or donate. Pre-commitment shrinks wiggle room for maybe it'll come back. Kahneman calls this separating System 2, planning from System 1, reacting. 2. Reframe as a series of bets, not one. A single coin flip feels scary. A 100 flip series smooths luck. Many positive expected value actions only shine in repeated play, like diversified investing or skills practice. Ask, if I could repeat this 100 times, would I want this rule? Prospect theory highlights how one-off framing exaggerates loss pain. 3. Automate smart defaults. Use automatic contributions or bill pay to make the good choice the easy one. Defaults beat willpower. This mirrors how organ donor defaults change behavior by reducing friction. 4. Separate past costs from future value. When deciding to continue a project, ignore what you've already spent. Money, time you can't recover. Ask only, from today forward, is this worth it? That mental move cuts the sunk cost cord shown in classic studies. 5. Decision journal, 30 seconds. When you buy, sell, commit, write, goal, reasons, what would change your mind, exit plan. Later, compare plan versus outcome. This builds feedback loops and reduces storytelling after losses, an idea popularized by behavioral authors like Morgan Housel. Results follow behavior more than the perfect spreadsheet. None of these eliminate risk. They just help you lose well, small, controlled, and fast, so your winners have room to compound. You don't have to feel different to act different. Design beats discipline. Here's your bonus insight, as promised. Try a one-line loss lesson log this week. Each time something loses money or time, write the smallest rule you'll use next time. Tiny, repeatable, done. Loss aversion shows how the pain of losing can overpower smart choices. Quick rewind. We started with a $100 coin flip, saw how that pain skews investing and sunk costs, explored daily life via endowment and default effects, checked a cautionary tale with Livermore, and finished with 5 tools to box in the bias. Today, this means losses feel about twice as strong as gains. Expect the feeling, plan around it. Use rules, automation, and journals to avoid just this once decisions. Judge choices by future value, not past spend. That's how you stop throwing good after bad. If this helped, hit subscribe and the bell so you don't miss the next one. And if you haven't already, check out our last video on Jesse Livermore, the greatest trader who made and lost $100 million. This video is for education only and isn't financial advice.